Are you worried about inheritance tax? Would you like to keep control of your assets and be able to pass them to your loved ones without them facing a tax bill of up to 40%? If you're an experienced investor, an inheritance tax portfolio could be a relatively simple and flexible way to protect your assets from the taxman. You keep ownership and control of your investments, and if you wish, you can even draw an income from them. Once you've held the portfolio for just 2 years, it could be passed on to your heirs or anyone you choose, free of inheritance tax when you die. Inheritance tax portfolios work by investing in companies that qualify for business relief, often known as Business Property Relief or BPR. This tax relief was introduced in 1976 so that family businesses could be passed down through generations free of inheritance tax. However, since 1996, the scope of the relief has been widened, and today anyone can benefit. So if you have shares, no matter how many, in a company that qualifies for business relief, you could pass them on with no inheritance tax to pay. Whether those shares are worth £1,000 or £1 million, if you've held them for at least 2 years and still hold them on death, current rules mean you can pass them on free of inheritance tax. If your circumstances change and you want some of that money, you can normally make withdrawals, although of course the amount you withdraw will no longer be inheritance tax free. Remember, tax rules can change and the value of benefits depend on your circumstances. So how can you invest in business relief qualifying companies? You could pick and choose your own shares to build your own portfolio. However, many prefer to leave that to a professional asset manager. Generally speaking, your portfolio will be made up of either AIM companies or unquoted trading companies that qualify for business relief. AIM shares are generally ISA eligible, which means you could transfer your existing ISAs to an AIM portfolio and make them potentially inheritance tax free. Unquoted companies can be many things. Portfolios typically include asset-backed businesses such as care homes and pubs. Some invest in renewable energy projects such as solar or wind farms. Others, instead of investing, may lend money, often against a property, either for development purposes or as a bridging loan. So what are the risks? Inheritance tax portfolios are investments. The unquoted portfolios are normally managed with cash preservation as a priority and aim for a modicum of growth, but there are no guarantees. The value could fall as well as rise, so you could get back less than you invest. Your capital is at risk. The companies you invest in may be smaller, newer, or subject to less stringent checks and regulations compared to a listed business. Inevitably, this carries extra risks, so business relief investments are not for everyone. You retain control of your assets and can access them if need be. However, AIM and unquoted shares are typically less liquid than those listed on a main stock exchange, so it will normally take longer to liquidate your portfolio. The shares can also be much more volatile. Please remember, tax rules can change, and the availability of business relief will require portfolio companies to maintain their qualifying status. Should they lose it, inheritance tax relief would be lost too. That said, for those comfortable with investing and the risks, inheritance tax portfolios could be an option to pass more of your assets to your family. Unlike many other forms of inheritance tax planning, you retain control of the investments. If you want to draw an income from them, you can, or if you ever need to cash them in completely, you can too. If you're unsure, you should seek advice.